I'll kick off today's session with kind of an overview on how we see the state of the market. Essentially telling you why now is still a great time to invest in venture and why it's a great time to continue to invest in MaC. What this is really about is framing what we're seeing today in the world of AI as not something entirely new. It's a cycle that we've seen before. And we're trying to show you that this is the point in the cycle where you should be investing in innovation and you should be investing in early stage venture. So to kick it off, every major VC downturn had a different trigger, right? For dot-coms, dot-com was everything, right? Everyone was piling money into any company that said dot-com, right? When we get to the global financial crisis, we're looking at 30-to-1 leverage. Like banks were loaning money to people to buy homes that couldn't afford it. They shouldn't have gotten it. And then at some point, the rent comes due or the mortgage comes due, and then we have a problem. COVID, right? There was a massive lockdown that changed the way that humans had to interact and businesses transacted, right? All these things produce the same outcome, but what that outcome is the thing that we want to focus here on. It's a reset that opened up a new opportunity. Four forces drive every downturn, right? It's easy money inflates bubbles, right? So it's low interest rates. Cash is free, creates bad behavior. A single narrative drives everything. Every company just adds AI to their name, and they can raise capital. Leverage, right? You over leverage things, and that creates economic problems. And then the last one is really important, and I think we don't spend enough time on it, but it's policy and regulation, and how what the federal government does, and how that can either accelerate the downturn that we're in or start the recovery. Every recovery is a road to a new platform, right? And it's a new playbook. It's not the old playbook, right? Every recovery was powered by a new platform. So if you think about, what happened after the dot-com bust, it was Web 2.0 and broadband being available in over 50% of households. So that made way for companies like Google to be created and to become what it was. In 2010 to 2014, what happened was we got introduced to mobile technology at scale, right? 4G, LTE. We had the Apple Store, the App Store, right? And that generated 194 apps annually on the platform. This made way for companies like Uber, Lyft, Airbnb. Again, at the downturn of these situations. And then the most recent one, agentic AI. We saw OpenAI become a real business, so to speak, or at least see massive distribution amongst consumers. And then we also saw physical companies find ways to decrease capital expenditure, which made them more viable for investment. In addition to the infrastructure and the platforms that start these recoveries, as I mentioned, there's policy shifts, right? And so you think about what happened with tax cuts and the Jobs Act, right? Those two paired together with the tech shift, they unlock capital and accelerated recoveries, right? You're reducing the cost of cash, which makes it more attractive for investors to invest in these technologies, right? So we got to watch regulation. Today, if you think about it, compute, energy, liquidity, they're starting to align with the opening of this new IPO market. And those things together, I think, can fuel a surge. So again, I think we are right at the point where we should be investing in innovation. We should be investing in early stage venture. Just to put a point on it, right? If you look at these companies, Google, founded in 1998, SpaceX 2002, Both these companies are worth, 2.3, 2.1 trillion respectively. Tesla, 2003, 1.2 trillion, right? All these companies founded in similar times to now, at the bottom of the market. So I think it's also important. I've heard a lot of reporters and journalists speaking about how venture is not adding up to the S&P, and you're better off putting your money in these indexes. And if you look at the historical numbers, that's just not true, right? Just as an example, I mean, if you look at the recovery in 2021, right, we're looking at 57x versus 28x. Over the course of a 25, 26 year period, we're looking at 36% versus 9%. And if you look at the actual chart, you can kind of see that venture will lag, in as the market starts to go down, and they'll probably end up below the S&P. But then they're going to skyrocket. They're gonna boom, and they're gonna go way past the S&P. And that's the beauty of having a diversified portfolio. Yes, you should invest in the S&P, but you also should invest in early stage venture, I think is the point here. And so let's run today through the same cycles, right? Today's market maps onto the same four forces that we talked about before. Zero rate excess, AI narrative concentration, rising leverage and infrastructure commitments, and ongoing Fed uncertainty, right? All this led to about 1,900 unicorns that are worth $3 trillion in unrealized value that are still sitting in the private market and not returning capital to LPs. Not great, right? But it's a cycle. It's not a structural crisis. So again, this is the time to invest in innovation, and this is the time to invest in early stage venture. More on that. Every trough became the launch pad, and the same signals are flashing now, right? And what I mean by that is the same three recovery signals from 2003, 2010, and 2021 are showing up now. The field is cleared. Now, a bunch of these AI companies that existed that had terrible balance sheets and didn't really have good technology and all that stuff, well, they've failed, right? The companies that are still standing are actually solid companies with significant runway ahead of them. A new platform has arrived. AI is here, right? And it's real, and it's a powerful tool. And now we're starting to see policy and liquidity turning, right? And I'm speaking about the IPO market. So all these things is a launch pad. It's momentum. And again, this is the time to invest in innovation. This is the time to invest in early stage venture. More on the IPOs. And so, the key takeaways here, right? So as the public markets reopen, it doesn't just reward the companies that list, right? It reliquefies the entire asset class, right? A wave of mega IPOs, we're talking SpaceX, which already filed or is already publicly offered, OpenAI, Anthropic, Databricks, others, right? They're gonna block this, they're gonna break up this liquidity logjam. This is gonna return capital to the LPs, so the LPs can redeploy it to early stage venture, and then we can redeploy it into the AI infrastructure stack. We got the risks look familiar, right? But the opportunity is different, right? Similarities to 1999. Concentrated funding, untethered multiples, a single dominant narrative justifying everything. But here are the differences, and here's what really matters here. The underlying companies, Microsoft, Google, NVIDIA, Meta, they're profitable. They're real businesses, right? They're real businesses. They're not going anywhere. And the speculation is concentrated rather than broad retail mania. So if you think of 2000, there was so much exposure to .com. If you think of 2009, it's people's homes, right? The exposure that we just saw with the early AI boom is concentrated. It's not going to affect that many people. So again, we're at the bottom. This is a time to invest, right? Innovation and early stage venture. So this slide, AI is like Uber in 2012, right? Let's talk about Webvan first, right? And the importance of having supporting infrastructure and a distribution channel. So Webvan was a terrific idea, right? Probably a good company, but they tried to do too much. You can't build the infrastructure and build the product, right? That needs to exist, and that's essentially what Uber did, right? Uber rode on the back of GPS payments, smartphones that already existed. They just added a product to it. We're at the same place now, where we're seeing energy, compute costs, trust regulation gaps, legacy system integrations remain unresolved. So these are the things that need to be fixed. If we want to find the next great companies, we've got to find the companies that are building 4G, LTE, the App Store for AI. Another thing I want to bring up really quickly is what's happening in venture capital itself, right? We're seeing a bifurcation of the market, right? There are really two types of firms. There are these new firms that are multi-billion-dollar firms, and they're the traditional early-stage firms. And we argue that both are valuable, both provide great things in the market, and as LPs, we posit that you should be investing in both. You just got to expect different outcomes, right? If you're going to invest in early-stage firms, you're looking at firms that are going to be investing in early companies that are building real companies that will allow you to drive returns for, call it limited outcomes, versus, and I mean big returns, like 10x plus, right? Versus the multi-billion-dollar funds. Now you're looking at late-stage investing. Maybe you get a 2x, a 3x. You're writing significant checks, and it becomes very hard to return those funds. But you could get a 2x, right? And if you're running a diversified portfolio, great to have both in there. Just to put a pin on it, I think everyone saw the Cursor transaction, right? And there are three different winners here. I argue that Neo is the biggest winner. They were earliest. They got the biggest share early, and that turned out to be 1.2 billion in return for them, right? They're a tiny fund, tiny accelerator. So that returned their fund multiple times. Then you look at and Andreessen Horowitz, who also invested early, but what they did was they continued to invest throughout the end. So they protected their ownership, and they ended up with a $6 billion outcome, which is also great for them. But how big is their fund? And then you've got Benchmark, right? Also a good outcome for them, right? Benchmark's funds are 300-400 million. So they invested pretty late, got a small stake, and they got close to or maybe just returned their fund, right? So three great outcomes. But the point here is the reason to invest in early stage venture is you get in early, which means you can get more ownership. And if you can protect that ownership, what you need to return your fund is a lot less than if you're these multi-billion-dollar mega funds. So I wouldn't be doing my job if I didn't say why you should be investing and continuing to invest with MaC, right? I think I said it before. We're at a point now where AI is only going to go as far as the supporting infrastructure and the distribution channels take it. And that's where we're investing. In terms of infrastructure, space, so there's a big push for data centers in space. We have companies that are helping to make that a reality, building the building blocks that will allow AI to actually scale to its potential. Energy, we talked about energy and compute as being a bottleneck, right? We have companies that we're very excited about in the energy space that can unlock, again, the potential of AI. And then distribution is super important. Traditionally, the companies that, that venture has backed have only benefited from customers that make up 20% of the US GDP. AI has the opportunity to get the other 80%, right? And specifically, I'm talking about physical AI and reindustrialization. And again, we're investing in companies in this space. And the last bucket here is security, right? So speaking of the other 20%, financial institutions and healthcare make up a good portion of that. But AI doesn't have a lot of legs in there yet because it's not secure enough yet, right? So we see a huge opportunity in security as well, and we're investing there. So to close out, and I appreciate you guys bearing with me as I talk at you for 15 minutes or so, but the field is clearing. The new platform has arrived. That's AI. The exit window is reopening. And this is the time to invest in innovation and early stage venture. Thank you.